Good morning, Lock Shield family. We are excited to have you back again this week as we do another market update. We apologize for not getting the video updated yesterday. We had some difficulties that we ran into that were unforeseen. So here we are this morning getting it back up and running for you. And today, the lesson that we wanted to focus on is about the temptation of timing the market. When markets are bad, it's very easy to fall into the temptation to say, well, let me pull everything back, let me pull everything out, let's go to risk free, and let's wait until the market recovers and then jump back in. What history has shown us, though, is that number one, it is impossible to determine when the best time to jump out and then precedingly jump back in is. But number two, if we don't get that exactly right, that can be incredibly costly over time. So in the link here, we've included a PDF from Franklin Templeton that they created a couple of years ago that highlights the dangers of market timing. What this form shows us, or what this chart shows us, is the 20-year investing time frame from January 1st, 2000 through December 31st, 2019. Over that time frame, we had 5,036 trading days where the stock exchanges were open. What we can see on the first page here is that it's assumed that an investor invested $10,000 into the S&P 500 on January 1st, 2000, and if they never touched it, the ending value at the end of that 20-year period would be $32,527 for an average annual return of around 6% per year. Historically, that's actually a fairly low 20-year return for stocks, but in that time frame you had the tech bubble burst, 9/11, and the housing market collapse. That's a lot going on in that first decade. What this chart then goes on to show us is what happens if we miss some of the top performing days over that 20-year period. And so if you scroll down, you can see the chart here that if we miss just the best 10 days out of those 5,036 trading days, then our return is cut in half. If we miss the top 20 days out of 5,000, we have nearly the same amount of money that we started with. And if we miss more than that, you can see the effect there as well. So what's interesting about this, and we can have a follow-up post on this next week, those top performing days tend to happen in the worst performing markets. And so what this graph shows us, and what many others out there show us as well, if we miss just a couple of those days when we have that natural human intuition to pull back on risk and we miss some of that upswing, then it's almost impossible to make that up over time. So here's your Lock Shield update for the week. Stay the course, focus on the long term, and manage that allocation properly. Thanks so much.